Hey, welcome everyone to another market update webinar. What week are we in?
Week infinity at this point.
Yeah, this is sixth or seventh, eighth one we've done. We've been in shelter in place kind of
3 months now, I think it is. It's almost exactly 3 months.
3 months. So give you a little bit of an update here at Pure Financial Advisors. Stage 3 just came out with the state of California. Here's our stance, and we'll have a letter that goes out to all of you here later on today, is especially in San Diego, for the clients that are in San Diego, you know, coming into this office building, we're on the 15th floor, and the elevators get jammed. And so we're going to take this very, very slowly to open up our office to clients and to employees. I've been coming into the office every day since this started, and it's, you know, I was the only car in the parking lot. We're seeing more and more cars coming in now. They only want 1 or 2 people in the elevators. There's only 4 or 5 elevators. When this thing starts filling up, it's going to be a nightmare, in my opinion, and it's not going to be a very good client experience of someone sitting in the lobby of our office building for a while. So be patient with us. If you do want to come into the office, of course, you can. Our office is open. Catherine is here in San Diego. Wendy's here in Irvine, and then we will have people filling in Brea and LA as well. But LA will probably be shut down for even a little bit longer period. San Diego will slowly start opening up. But again, we have like 250 to 300 appointments a week before COVID. So for us to understand everything, we're working very diligently on, you know, making sure that everything is clean and how many clients that we can have in everything else. It's very fluid, so we're on top of it. We're learning something new every single day. But just for the time being, we're going to keep client appointments at a bare minimum. But again, if it's important for you to come into the office, of course, we can make those arrangements. So with that being said, let's see. I guess this doesn't work. So we'll go here. Question and answers. So we got Brian
just so
Perry.
you know, you should be able to just use the arrow keys to go back and forth in the slides.
Yeah, I know, Andy. I've been hitting those arrows since we started this thing.
You should be able to and able to are 2 different things, right?
Got it. Okay.
So if you do have a question, the Q&A button, please ask your questions. That's why we do these. This is live, as you can probably tell. My name's Joe Anderson, president here at Pure Financial Advisors. Brian Perry, of course, is with me again. He's our executive VP and director of research. So the bulk of this presentation will be geared towards Brian, a little bit more of a market update, just seeing what to do next with everything else. Our COVID response is still on the front page of our website. You can read our blogs, and all the other things that we're putting out in regards to this is right there. Any client newsletters and so on and so forth. So the agenda today, we'll look at COVID-19 and the economy, the state of the markets. We'll look ahead to November. And then, of course, this is your time. We'll open up to Q&A. So this is your time. We want to make sure that we answer all of your questions, but I don't want to bore you to death and stick around for a couple of hours. So we'll try to wrap this thing up in a half an hour, depending on the questions, 45 minutes at the max. So without further ado, I'll get Brian. There you go.
We're going in the right direction. And, you know, we may not be able to use the clicker, but last I looked, the Dow was up another 600 points. It seems like every time we do one of these, we have a pretty good day in the stock market. You know, let's talk a little about the economy, though. And if we look at the first slide, which is retail sales, the title is Implode, and it's a pretty strong word. But when you look at this chart, there's no other word for it. I mean, look at the biggest moves in history. You know, maybe back in 2002, you had a brief time where they went up 6 or 7%, but always around that median of 0, and then all of a sudden we fall 15%. So that's the sharpest drop we've ever seen, and that's what happens when we're shelter in place, right? You can't go out and you can't spend money other than at the food store or online shopping. Similar story at restaurants, where you can see these are in different states, and you can see this is measured by OpenTable, the app to book reservations. You can see just fell off a cliff and activity down 100%, which is just staggering. And the problem for a lot of businesses is when you do your modeling for what's going to happen in the future, I don't think you ever forecast a scenario where revenues drop 100%, and yet it did happen. Here's the good news, though, folks, is that look at the second half of this chart where you can see some of these squiggly lines starting to move higher. We are seeing restaurants open here in San Diego. And again, it varies by locale. My understanding is LA is a little slower to open maybe than San Diego or Orange County, but things are beginning to open. Florida's back to 50% of where it was. Texas, the same thing. California, a little bit slower, but we're still a quarter of the way back. So activity beginning to pick up, which is a good thing. We can start to go out of our houses. You can go to the beach and stuff like that. And some people are being hired back. Employment has recovered a little bit. The initial jobless claims each week, while still at extremely low levels, are actually improving. Things are getting slightly better. But here's the rub. This chart looks at the U.S. employment to population ratio, which is what percentage of people in the United States are employed. We're down around half. We're close to where more than half the people in the United States are not working. Right? If you want an argument for higher taxes in addition to everything else, and one of the reasons we always talk about it, imagine a country in which less than half the people are working and paying taxes, right? That's why we worry about this. And granted, there's a major recession going on, but the percentage of the U.S. population that's been working has been declining for decades. And given COVID-19 and what a lot of people that we talk to, hey, I was thinking of retiring or in a few years, but maybe I got furloughed, maybe I'll stop working. This ratio could easily stay lower, and it is yet another reason why we're so focused on, what taxes may do in the future. Another thing that we look at, though, is when is the economy going to improve, right? And I think it all comes down to COVID-19. And I wish I had a crystal ball. I don't think anybody does. When will this disease end? Right? I think what we really need is one of two things. We either need widespread immunization, so we need a vaccine that many, many people have gotten, or we need what they call their herd immunity, right? Where enough of us have had it that then we're protected. I've heard 60% of the population needs to have it in order to be considered immune as a population. The most recent estimate I saw is that maybe 5% of the people in the world have had it to date. So we're not that close to the herd immunity. But nevertheless, confirmed cases and fatalities have been dropping as of June 4th. Here's the deal. The news is going to be bad. Joe and I were talking yesterday. If it bleeds, it leads, right? Bad news attracts eyeballs. The news isn't necessarily going to be good. There were headlines the last few days about Texas and record hospitalizations. That's what happens. It's hard to get sick when you're locked in your house as you start to go out and live your life. Cases, fatalities are going to go up as long as they don't spike so severely that we have to go back into our rabbit holes. I think the economy will continue to grow, albeit from very low levels. Right. One last thing I want to touch on the economy, and that's inflation, right? We get a lot of questions, hey, the money supply, and there's a lot going on this chart, so don't try to memorize it. Just look at the blue line and the yellow line here at the end, and you can see that blue line spikes vertically higher. That's the money supply. That's the amount of dollars that have been issued and is a direct result of everything the Federal Reserve is doing. And what happens is that going all the way back to the 60s and 70s, people worry that when there's a lot of money, it leads to inflation. Right? If there's more money out there, it's chasing a finite amount of goods, prices have to go higher. And that is what happened in the 1970s for those of you that were around and remember really high inflation and stagflation and gas lines and stuff. But here's the deal. It's one thing to have dollars. It's another thing to spend them. That yellow line is the velocity of money. So that measures how often each dollar in circulation is getting turned over. You can see that at the same time the money supply is going higher, the turnover of money is declining at the same rate. So although there are a lot more dollars out there, most of them are just being held on bank balance sheets at this point, not actually being turned around in the economy. So if you want to keep an eye out for inflation, I don't think it's one of those things where you don't have to worry about it at all. I just don't think you have to worry about it today. Later on down the road, as we come out of this recession, and I don't think this is 2020, it might not even be 2021, down the road, if people begin spending and the velocity of all these newly created dollars go up, that's where inflation could potentially come into play. And I think that inflation view is being shown out in the Treasury market, if we look at it, with the 2-year Treasury here. And you all probably remember that for the better part of a decade after the financial crisis, you basically got zero on cash and on short-term investments. And then we got a reprieve for those of you that are savers, and interest rates started going up in about 2015, 2016. We got all the way to 2 or 3% on overnight rates and on 2-year treasuries. And We stayed there for all of about 20 minutes, and we've turned around and gone back south, and we're back down right around zero. This is telling you right here that the bond market and the U.S. Treasury market are not afraid of inflation here in the next couple of years. This is also one of the reasons we get this question all the time. Why don't I just sit in cash till things are calmer? Because sitting in cash is a penalty. If you could get 4 or 5% sitting in cash, it might be a different conversation. For the most part, you get 0, maybe 1%. We could get creative, get 1.25. You're not getting a whole lot of return, and it's tough to meet your financial goals at those rates. Right? However, longer term, you can see here that interest rates, the yellow line is the beginning of January of this year, and the blue line is more recently. You can see that sharp decline in just a 6-month period. Interest rates going from 1.5% at the short end to close to 0. But longer term rates haven't come down as much. And that does tell you that although we have very low inflation, very low interest rates today, the market is pricing in a little bit higher rates, a little bit higher inflation down the road. This is one of the main reasons we're taking a cautious stance in some of our bond portfolios. It's not because we don't think you can get a little more return by investing out longer. It's just because the amount of excess return you can get isn't that great. We want to take a little bit of risk in that bond portfolio, get some return, but we also want to play a little bit of defense because in the long run, it does look like rates and inflation could head higher. All right, let's shift gears a little and talk stocks, all right? S&P 500 over 1 year, there's a lot going on here. You can see the cliff we fell off of there at the end of February and beginning of March, and then the mountain we've climbed since then, recovering up about 40-45% by some indexes from low to high as of recently. And then again, recently, a little bit of a sell-off, and a lot of that has to do with a couple things. One of them was just the spike in COVID cases as people come out of their homes and begin living their lives. The other is just that when you have that much of a rally, and particularly off of bad news, the market's looking for reasons to sell off, and that's just a fact. Markets go up and go down. But here's the thing, because another one of those annoying things that maybe you get tired of hearing is stay the course and take a long-term time horizon. Guys, it's been a crazy year, hasn't it, Joe?
To say the least.
Yeah, to say the least, right? And we haven't even gotten into this. We'll talk about silly season and the election here in a bit, but it has been a crazy year, right? We're exactly where we were a year ago in the stock market, right? If any of you are lucky enough to have a big boat and have been around sailing in the last year, you'd have thought nothing has happened, right? You've been cruising around on your boat. This is why we preach taking that long-term time horizon. And for all you out there, I don't know that we're out of the woods yet. I think that it's going to continue to be a bumpy ride until we get a COVID-19 vaccine. And after that, there'll be something else to focus on, whether it's an election or inflation or China or this or that. There's always going to be something that moves markets up and down. We're going to go down again just as surely as we've gone up. But you take that long-term time horizon, and even one of the major events of our lifetime, which is all being forced into our homes to shelter in place, still starts to disappear over a long enough chart. Right, I want to talk here a little bit about international stocks versus the U.S. All right, and this blue chart, the one that's gone up a whole bunch, that's the S&P 500 since 2015. The yellow chart, that's the MSCI All World Index. That's basically all international stocks, everything in the world except the U.S. And what you're all probably noticing is that blue chart's gone up a lot more than that yellow chart. U.S. stocks measured by the S&P have done a lot better than international stocks, right? And so sometimes we get the question, hey, why diversify internationally? Why does that make sense? Why is the U.S. doing so much better? Well, here's the deal. That blue chart's the S&P 500. That red chart's the S&P 494. So in other words, that red chart is the S&P 500 if you take out Facebook, Apple, Alphabet, Amazon, Netflix, and Microsoft. 6 stocks have been responsible for that entire differential between all the stocks in the U.S., all the stocks in the world, and then the S&P 500, right? 6 stocks. And so then the logical question we get is, well, why don't you guys own those 6 stocks? Why would you not own these companies? They're great companies. And here's our answer. We agree. We do. Well, if we flip to the next chart, this is the top 5 holdings of the main U.S. equity fund that we hold. So this is the biggest portion of our U.S. stock holdings, the biggest portion of our stock holdings. These are the 5 biggest holdings in there. Apple, Microsoft, Amazon, Alphabet, Facebook. Sounds a lot like those stocks that have been driving the market, right? We're not oblivious to the fact that these are great companies. We own them. And in fact, we hold them as the largest percentage of the portfolios that we own, right? That each of you are invested in. Right? Here's the difference, though, is that we own relatively less of them than the S&P 500. If you look at those handful of stocks, they're about 20% of the S&P 500. And in our view, it just doesn't make sense to have 20% of your wealth, 20% of your future locked up in a handful of companies, no matter how great. Because when companies have done that well, there's a whole lot of good news priced in. And yeah, they could continue to go up, but it's not just that they have to be great companies or that they have to do well. They have to do better than expectations, and expectations are pretty lofty. We just believe that when it comes to retirement planning and saving for the future, a little bit more diversification makes a lot more sense, particularly when you look at the way that the average person at home is investing. And so this is for those of you familiar with the Robinhood app, this is one of those free trading platforms that have become popular, particularly with millennials, but also with other people. And it looks at the stocks held in those accounts. And you can see that the orange line is all stocks. The green line is the 10 stocks 5 through 15 in market cap. And then the blue line is the 6 biggest companies. And you can see that most of the people, so this is your average, when you picture the stereotypical, back in the 90s, the taxi cab driver quitting their job to day trade or something like that, this is measuring that. And you can see the stocks they hold. It's those handful of stocks that have been driving the market. Then what happens is that when those kind of investors tend to pile in, a lot of times that can signal bad news, particularly when sentiment gets out of whack. And when you look at this line, what this looks like is are people optimistic or pessimistic? And you can see towards the right-hand side of this, back in March and April, we were extremely low. People were extremely pessimistic. And what happened? The market rallied tremendously. Now we've come to where people are extremely optimistic. And just to be clear, sentiment matters. So in general, if the whole world's bullish, if the whole world's optimistic, there's nobody left to buy, right? If everybody's all in, who's going to buy, right? Flip side, if everybody's pessimistic, when times seem worse, there's nobody left to sell. And usually that's when markets rally. Here's the key thing, though, is just because people are pessimistic or optimistic doesn't mean markets are going up and down. All it means is that the market is susceptible to something that will prompt it to go up or down. So this isn't necessarily a cause. It's more of an accelerant. But this does tell you that people have become a lot more optimistic recently. So that's one reason we want to be cautious on this handful of stocks. Here's the other one, right? None of you have probably ever invested in the Dutch East India Company or even heard about it since high school history class. But in its day, the Dutch East India Company was the largest company in history. If you adjust for inflation, the Dutch East India Company was as big as Apple, Alphabet, Microsoft, Amazon, Facebook, Exxon, Bank America, Wells Fargo, Samsung, McDonald's, Netflix, Tesla, Chevron, Walmart, and a host of others all put together. Right? And so the question becomes, do you think when Dutch East India Company was as big as 20 of these corporate titans put together, that it had done well recently? Probably. Do you think the news was good? Probably. Do you think the future seemed bright? Probably. And yet the company doesn't exist anymore. And so the point being, just because something has done well doesn't mean it's guaranteed to continue to do well. And again, this isn't a judgment or saying that these handful of stocks that have been driving the market are bad companies or aren't going to do well. We like them a lot, which is why they're our biggest holdings. We just think it makes sense to spread out positions a little bit more because you never know what's going to happen. All right, we often get the question, we actually just got this recently of, hey, I'm paraphrasing here, but the news is all bad. Everybody knows things are going to be terrible. There'll be a second wave of COVID-19. The economy is going to head south. Why would you not just sit in cash? Right? And what's interesting here, this chart looks at data going back to 1948, and it looks at the unemployment rate, and it breaks it into times when it's below 4.3%, above 6%, or anywhere in between there. And it looks at times when the economy is growing less than 0.8%, more than 6%, or somewhere in between there. And then it looks at when earnings on the S&P 500 are growing a lot, growing a little, or growing somewhere in the middle. And what you see is that the best returns in the stock market have come when unemployment is the highest, the economy is growing the least, and profits are the weakest. Right? I think that bears saying again, because this is why we don't abandon things when the future looks bleak, because the stock market in the last 70 years has done the best when unemployment's the highest, the economy is shrinking, and profits are weak. Right? Again, it gets back to that when there's a lot of bad news out there, there's nobody left to sell versus when there's a lot of good news and everybody wants to buy, there's nobody left to buy. This is why, even though there are still a lot of challenges on the horizon, we're hesitant to abandon ship. It's why we continue to focus on diversification, having stocks and also having bonds so that there's something to rebalance into, right? We don't want to abandon the stock market. For the most part, we also don't want to jump in with both feet. We want to be measured. Right? I want to turn ahead here and take a quick look at the silly season. I think that if coming into the year we had looked at what the top stories would be, we probably would have had a plurality that would have said the election would have been the dominant story. And it's really faded to the back burner thanks to the coronavirus, right? But, you know, as we begin to come out of our homes, as the disease hopefully dissipates, you'll probably start to see more and more market movements directly related to the election. And you'll see a couple of headlines going on. And one is that, and we've seen this resurface recently, is talk about trade wars. So we had the last couple of years, the economy and the stock market have done quite well. The one thing that's consistently been able to derail it from 2016 through 2019 was tariffs on China, talks of trade wars between the U.S. and China or Europe or whatever. Then that went away, right? There was a trade agreement put in place, and then we got into coronavirus and nothing was going on. And now you've heard more talk coming out of Washington about China and trade and stuff like that. That is likely to continue, and here's why. This is the percentage of people that are Republican and Democrat that have an unfavorable opinion of China. And as you can see, more than half, and in Republicans' cases, almost 3/4 of Americans have an unfavorable opinion of China, right? Politicians have probably looked at this in a lot more detail than this one particular chart. This chart comes from the Pew Research Center, which is pretty reputable, right? What this tells you is that politicians can make hay by taking an aggressive stance on trade with China. They know that. Trump certainly has been very adamant in his view on China, actually throughout his life, going back to the 1980s, and then certainly since he's been president, and probably will continue to be so. So don't be surprised if you see more and more talk about trade imbalances, trade wars, and that kind of stuff. I would not be surprised to see a lot of talk about it heading into November, followed by probably a backing off from that stance, because at a time when the global economy is weak, trade war doesn't benefit anybody, but you'll probably hear a lot of rhetoric, so it'll be important to separate the wheat from the chaff as far as this goes on. The other thing is, who's going to win the election, right? I mean, I think that if we had looked at this 6 months ago, Trump was in a pretty good position. Usually incumbent presidents win re-election unless there's a recession and unemployment is high. These are the 10 states that had the closest races back in 2016. You can see some went to the Democrats, some went to the Republicans. But just look at the unemployment rate in these 10 states. So these are your proverbial swing states, right? I mean, I think it's pretty commonly accepted that, I don't know, California usually votes Democrat. There are some other states that are pretty locked into the Republicans. These are your swing states. You can see that in all of them, unemployment is very high. In all but one, unemployment's double digits. So to me, the one determinant of whether or not Trump wins is going to be what happens here. You know, how quickly do we come out of shelter in place? How much does unemployment fall? Can he take a victory lap for saying that he got us through coronavirus with, I don't know what the right word here is, because I don't want to minimize the amount of people that have passed away, but I don't want to say an acceptable rate of casualties, but that the spread of the disease was as contained as it could be, while at the same time the economy wasn't completely destroyed. Or do unemployment rates stay high? And then, I think this would pave the way for Biden to win the election. It also depends. Remember, as you're talking to your friends, that unemployment isn't uniform. And so if you look at this, in general, the higher the educational attainment, the lower the unemployment rate. And this has been the case for decades, right? If not, and a lot of this goes back to globalization. In a global economy and in the internet and computer age, people with more education tend to have better employment prospects and have traditionally had pretty low unemployment rates for the better part of several decades, whereas people with less education have tended to have higher unemployment rates. And this is a lot of what fueled Trump's rise. Was for sometimes people living on the coast may not be as affected, but there's a lot of middle America and some of the more industrial states that have lost a lot of jobs, and those jobs have been replaced by lower wage jobs. A lot of people have seen their standards of living stagnate or even decline for years and for decades, and that's what Trump has played on in the past. It's what Joe Biden was trying to play on, and it's probably going to be a popular topic now and in elections to come. And here's why I'm bringing this up is, everybody has their own view on who they want to win the election, but it's important to separate what you want to happen versus what is likely to happen, right? And if you look here, red is Republican, blue is Democrat, white's independent. You can see that when Obama was elected, Democrats, if you tilt to the right, that means that your view of the economy is improving. If you tilt to the left, it means that your view of the economy is declining. You can see that when Obama was elected, Democrats, their view of the economy improved. Republicans thought things got worse. And then look at the big swing coming out of Obama into Trump, where Republicans all of a sudden thought the economy got 50% better. Democrats thought it got 25% worse, right? And we've yet to reach the point where the president comes out, whoever's elected comes out and targets everybody that didn't vote for them, right? And so I think that the truth was probably somewhere in the middle, right? The economy probably got a little bit better, but not as good as Republicans thought. It certainly didn't get as bad as Democrats thought. The reason I bring this up is, regardless of your view of who you want to see elected, try to differentiate that from your view of the economy or what is likely to happen to the economy and financial markets. Particularly, and we'll end with this slide and then we'll open up to Q&A, is because under almost all presidents, stocks have gone higher, right? There's a ton of dots on this line, but if you just look, everything above 0 means that the stock market improved during a presidential term. And you've got every president back to Warren Harding here. And you can see that under almost all presidents, stock markets have gone higher. There's also a pretty common perception that stocks do better, or that Republican presidents are more pro-business. That may or may not be true, but the reality is that there's only 3 presidents under whom stocks have declined while they were in office, and they were all Republican, right? It was George W. Bush, it was Richard Nixon, and then it was Herbert Hoover, are the only 3 presidents whose stocks fell while they were in office. So the reality is that we're entering into the time of year where you're going to start to see more and more rhetoric, more and more hyperbole. Markets may occasionally swing wildly based on a proposal from Trump or a proposal from Biden or who seems likely to win the election. But it's really about settling in. You'll see market movements, but it's about settling in and then seeing what people actually do once they're in office. Because the reality is that a vaccine for COVID or herd immunity for COVID, the future of inflation, the future of employment, corporate earnings, those are all probably going to have a lot more of an impact on the stock market and other markets going forward than who wins the election in November.
Andy, let's open it up for some Q&A.
Yep. So just as a reminder, if you do have a question, click the Q&A button on the bottom of Zoom and send those on in. I guess we did just answer the one question. Given how President Trump's monetary policies have seemed to boost the stock market, what impact will Biden have?
So I mean, the one thing I'd say is when you talk about monetary policy, that's really the Federal Reserve that controls that. The president can have an impact on fiscal policy along with a heavy weigh-in from Congress, who makes the laws on fiscal responses. Monetary policy is the Federal Reserve, so the president has some ability to, depending on when terms expire, to appoint the Federal Reserve chairman as well as the regional governors or the regional bank heads and the governors. I think actually, to a degree, Trump has been more against the Fed than most. He's been more inserting himself into Federal Reserve decision-making and been more public about trying to control what the Fed does. So he has been a proponent of easy money, which isn't a surprise given that his background's in real estate and easy money tends to help real estate. But we'll see. The Federal Reserve is based upon a fundamental principle of being independent. So hypothetically and historically, whoever wins the election shouldn't have an impact on monetary policy, but we'll see.
Okay, the next one. It seems that value stocks continue to struggle. Do you foresee any improvement in the prospects for value investors?
Well, I hope so. I think that the one thing I would say is that value stocks and growth stocks are one way of rolling up the stock market or aggregating the stock market. But another way to look at it is sectors. And a lot of it has to do with what sectors fall into a particular bucket of value or growth. And when you look at growth, a lot of that is technology. And, like we looked at in that one chart, technology, particularly that handful of large growth technology companies have been driving the market. Those all happen to be growth stocks. And so I think that a large proportion, if you look at the performance of value stocks, they've performed not terribly dissimilar to historical averages. Where the differential has come into play is that growth stocks have done much better than historical averages, driven primarily by that handful of large tech companies. But when I break it down to sectors, I think that, if you look at energy companies, for instance, had a poor start to the year as oil prices went from 60 to 10. Oil prices have recovered from 30 to 30. Those stocks have done a little bit better. Financials have started to recover as the economy does better. Materials companies, all of which fall into value, have started to do a little bit better as the economy has started to do better. So, if we can continue to go forward and get the economy going in the right direction, I think value stocks and the sectors that comprise value stocks will start to improve. Also, valuation matters. And on a relative basis, value stocks by definition are cheaper than growth. But if you look at value stocks relative to the historical average price of value stocks, they're very, very cheap, which would argue, again, doesn't tell you what's going to happen tomorrow or next week, but does suggest that over time they should do pretty well.
Martin says, are we in basically a whipsaw, i.e. we get small gains, then give back the previous several days of gains and maybe a little more than the gains we got previously? Given the number of businesses that will not come back and continued unemployment, will our portfolios continue to drift a net down?
I don't know. Significant
Yeah.
volatility, I think, now until there's a vaccine. So I would just buckle up and hold on, and it's a very interesting time. I don't think we're going to abandon any of our core strategies. We're looking to continue to manage the risks in all of your portfolios, taking advantage of tax opportunities as we see them. I wish we all had a crystal ball of figuring out exactly when to get in and out. But yeah, it kind of does feel like a whipsaw. Some weeks are great. It's like, I can't believe the market's doing this. No one really understands it. Then the next week it's down. It's like, well, okay, well, that makes sense, but yeah, it hurts, So we don't necessarily have a crystal ball on what the markets are going to do. But this is basically a short period of time, given all of your overall time horizons when you look at it like that.
Yeah, I agree 100%. And, I'd also throw in that I think most folks, and probably ourselves included, are looking at the S&P 500 or the Dow as like the market movements, and the news flow we're seeing is, I don't know, cases in Texas is spiking or something like that, right? The reality is that there's a reason we invest globally. And I've always been convicted on global investing, but I don't think I've ever had more conviction, if for no other reason than different countries went into and are coming out of COVID very differently. So I don't think any of us, I'm going to assume none of us, have a daily tracker on our desk showing like cases in South Korea or India or something like that, right? And yet each of those countries and regions and businesses within those countries are recovering at different rates. And so I think that you're going to see starkly different performance among different countries. And the U.S. may or may not be the best, but I think having that global diversification is going to expose portfolios to countries where, for instance, South Korea, where they shut down really quick and they seem to have recovered really well. Australia and New Zealand, same thing. New Zealand had a rugby match yesterday with 50,000 people at it, right? So there's, again, admittedly a small portion of the portfolio in some of these countries, but that diversification, I think, will pay dividends as countries recover from COVID at different rates.
Okay, here's an interesting one that we received via email yesterday. I read an article in the New York Times that gamblers without their usual places available for gambling have now turned to investing in the stock market and are having a market effect on the volatility of the market. How is your firm dealing with the effects of gamblers when gauging the direction of the market and making decisions that affect your legitimate investors and clients?
Well, I know that gamblers are back. If you looked at the Charles Schwab PGA event, I think that's the only live sporting event that we've seen in weeks. I mean, I think Vegas came out and saying, I mean, I've never seen anyone bet so much on a PGA Tour event. So yeah, there's definitely some of that. Gamblers need to gamble. But when you look at the movement of the overall markets, those are institutions and big endowments and hedge funds and mutual funds. So you look at the retail sector of individuals, gambling their own savings. We'll definitely have some movement in the overall markets, but I don't think a ton. You look at the average savings of just an average American. You look at a retirement account of someone 55 to 65. It's 50 grand. And are they gambling their life savings to try to make it larger? Yeah, in some cases people are, but I think there's some movement there. I don't think it's a ton. I think those are clickbaits. I think there's other things that drive the overall markets, but who knows?
Yeah, agreed, right? And mom and pop with $50,000 versus BlackRock has $6 trillion with a T, right? I mean, which is moving markets, and I'm going to go out on a limb and say that BlackRock's not gambling.
Right, and I mean they have a fiduciary standard, and
of course,
they're looking at an investment policy statement and so on. So.
All
Yeah.
right, John would like to know, any thoughts on how civil unrest is and or will affect the economy and the stock market?
Well, we're seeing it now. I mean, we're seeing volatility all over the place. So last week we're down 8%. I mean, this week we're trending upwards. New information comes out, by the second. So the market reacts a little bit differently depending on the news. So yeah, we'll definitely see a lot of volatility over the next several months.
The one thing is that both the market was so low, economic activity was so low that it doesn't take a whole lot to improve, right? If you think back to that one chart we had with restaurant reservations, when your business is down 100%, it doesn't take a whole lot of good news to be better than down 100%, right? So you could throw in a lot of, whatever it is, civil unrest, bad news, spikes in vaccines. If people are out and living some sort of their life, economic data is going to be better than it was 2 months ago, just by definition.
Okay, next question is back to Biden. People are talking about Biden's presidency will hurt the market. What's your opinion?
It doesn't. I mean, you look at if it's a Republican or a Democrat. If you look at the history of the overall markets, in most cases, the markets have gone up. So, our opinion is we can only control what we can control, and making sure that we're making appropriate moves, given what the environment that we're living in.
And I think people would have said the same thing about Obama and probably the same thing about Clinton. And those are two of the best stock markets of our lifetimes. Right. So I think to a degree, I think the markets can live with Biden. I don't think Biden worries. Now, the market may have a preference and different sectors may do better or worse, but I think Bernie Sanders was probably a candidate the markets would have struggled under, at least initially, and with him dropping out. And maybe Elizabeth Warren, if she were to become vice president, the markets might not love that in the short term. But again, even in the short term, even if you get somebody that the market doesn't love, the market could sell off. I mean, it sold off when Trump got elected, right? And then it went up a whole bunch. So just because it doesn't initially like it, I mean, the proof is in the pudding, not in the initial reaction.
Okay, and then the final question that we have here is actually regarding the Pure merger. It says, Ken would like to know, what does the merger mean for your existing clients?
I don't know. Did we merge?
Wait, hang on.
I don't know.
Wait, I didn't get the memo. Jeez.
A couple of things is that there was no merger. There was a silent partner, Immigrant Bank, out of New York. And they have a significant expertise in a lot of different areas that we're looking at. So they're a small minority silent partner. They are also invested in probably 15 different registered investment advisors, very similar to us, $2.5 to $3 billion in size. So the benefit for us was for us to share best practices. So we have now a group of individuals, CEOs, top executives around the country that are running very, very large, successful businesses, looking at different alternatives in regards to investment structure, bringing in best minds for all sorts of different other types of ancillary services that we potentially can provide our clients. Could potentially bring costs down. So it was a big win-win for us, just to be able to enjoy some other intellectual capital. I mean, we started this firm from scratch, basically 12, 13 years ago. And we grew it basically one client at a time, in a lot of hard work. And I think we built a platform. The vision for myself and Mike Fennison and Al and Paul, when we started this, is that, there's a lot of advisory firms out there that don't necessarily give advice on a fiduciary standard, that the quality of advice is not to the level where individuals should be getting that advice. Still, the industry is commission-based, big brokerage houses selling, product that are not necessarily in the best interest or may or may not be in the best interest. They're still filled with fees, costs, commissions. So the vision in the goal of Pure was to really bring family office type services where you could have a collaboration of tax experts, investment experts, insurance experts, estate planning attorneys, and the certified financial planner acting as the quarterback and bringing in all these different capabilities to the client life. So that was the mission and the goal, but it's pretty expensive to do that. That's why most of these family offices, you have to have $20 million just to become a client. Our goal was never to have a minimum investment. So if someone came to us with 20,000 or 20 million, we could handle those types of individuals or those families. The goal is still true, is that we want to give good quality advice to the mass affluent. There's a lot of people that need financial planning help. And that's the mission of mine in the firm. That doesn't mean our existing clients are going to see any type of reduction in overall service, because what we did in the beginning is that we capped our advisors to say you can only service 150 clients. Once you reach 150 clients, you cannot service any more, just because the level of service that we try to provide our clients is number one. If there's any level of service that goes down, right, I'm usually the first one to know about it, and we rectify that situation fairly quickly. So for our clients is the number one goal. We want to make sure that we can still enhance the client relationship, all of you. We want to make sure that we can bring better services, a better suite of services, potentially better technology as things advance. Where we need to be on the cutting edge of how do we give the quality advice to all of you. And so that was the key component. Mike Fennison was the founder and the CEO of the overall firm. He is now semi-retired. He moved to Florida. And so he wanted to have a little bit of a liquidity event and bring in another firm that could add a little bit more value. So Mike is still the chairman. Al is still the CEO. I'm the president. So there's no changes in management. There's no changes in operations. There's no changes in anything really in regard to the overall structure. So.
Okay, we did get one more question while you were answering that one. Marty says, for retirees, given the fact that consumers drive the market and that the stock market is not the economy, what would be a good current cash allocation to have dry powder ready if or when the market adjusts again?
Dry powder. Yeah. I like it, Marty. I think what you have to look at is the overall cash demand from the portfolio, right? How much money are you trying to derive from the portfolio to provide a lifestyle? We look at having at least 7 to 8 years of very liquid, somewhat safe investment. That could be your dry powder. So,
yeah, I mean, if you're keeping too much aside from your rainy day fund and then the dry powder Joe's talking about, which a lot of times is in high quality bonds, right? If you're keeping too much additional, at that point, it's really timing the market based on, hey, I think that stocks are going to fall. And, that's a tough game to play and one that we try to avoid.
And that's all the questions we have.
Okay, great. Want to thank everyone for joining us once again. Hopefully you're finding these useful, valuable. I know we had several hundred people on the call today, so that's always good to see. We're really excited to get all of you back into the office. It's been a very interesting 3 months doing these webinars and talking via Zoom and remotely and on the phone. It'd be nice to see your smiling faces come in and, into our offices. However, with that being said, we're taking a look at, the high level precautions. Our average age of our clients is, roughly around 60 years of age that are, retired or transitioning into retirement. So we want to take a look at that. Plus, we want you to come in to enjoy the experience and not sitting in the lobby, waiting 20 minutes to get up, unless you want to walk up the stairs. And believe me, I've done that a few times. That could get you a good workout. So stay tuned. Again, if you want to come into the office, we're doing very few appointments. And there's certain protocols that you must follow when you come into the offices. So talk to your advisor to get more information there. I think Alan is going to be sending out an email here shortly to give you an update basically on what the protocols look like and what our plans are for reopening our offices. I think Brea, we might be a little bit more lenient in regards to you just walk one door and you're right into the office versus our other locations. There's elevators and they're big offices, and we just want to make sure that we're safe. Things have been working really well. Most of our employees are working remotely still. We only have a very small handful of people that come into the office. We have 70 employees roughly, and there's probably 5 people in the overall office, just to kind of give you an idea. And we're still, keeping all of our advisors, most of our support staff working remotely, maybe even till the end of the summer. So we're just kind of taking a look at it week by week, day by day. And then as more information comes out, we'll make sure we get that information out to you.
We did have another question come in. Did you want to take that too?
Sure, why not? Yeah, I don't care.
Suggestion made, keep about 1 year liquid assets for downtimes such as these. What type of liquid asset combination would you suggest rather than just cash in a bank?
Well, we got something, max your interest, that you could ask your advisor about. You could probably get maybe 2
Probably closer to one
One
and
and
a
a
quarter,
half,
one
one
and a
and a
half.
quarter?
It's been coming down, but yeah, you can still get well above 1%, which is a lot more than most banks. So yeah, talk to your advisor. They can get you more information on that. It's a decent cash solution for excess cash.
Yeah, so if you have excess cash, if you're looking cash on the sidelines, you don't necessarily want to invest it. You want to wait for that dry powder or jam it in whenever, yeah, we do have options available. Max your interest. Talk to your advisor about that. You can get a little bit better than CD rates in some instances.
And with more liquidity than a CD.
Yeah,
you can get in, you can get out. So yeah.
Now I think that's all the questions we have.
Okay, all righty. Well, thanks again, everyone. We like I said, be safe out there. We will be back here soon. And like I said, if you like these, just let us know what questions that you have, and we'll keep pumping them out. So, Andy, thanks so much for everything.
Thank you.
Thank you, Brian, and we'll talk to you all real soon.